our guest says investors might need to become more cautious on the market in the near term. We're joined by Denis Taillefer, Senior Portfolio Manager at Caldwell Investment Management. Denis, thanks very much indeed. You are a little wary of valuations right now.
Well, yeah, the market's done very, very well, right? If you look at the market off of its April lows, it's up about 40%. Valuations are a little stretched here. So we've had a really good run. This is on the back of, we're in the fourth year of a bull market, so 3 years of really good returns. Mm-hmm. So yeah, we do think, things are maybe a little ahead of themselves. We still have a positive view on the market for the year, but especially the way the year started, when you look at the precious metals, they've had significant runs since the beginning of the year. Mm-hmm. They were in really overbought territory. We've seen a pretty significant pullback, but year to date, gold is still up 8%, I think, and silver is still up close to 10%. So we just think things were getting a little too maybe a little too frothy in the near term. But overall, for the year, we still have a fairly constructive view on the markets. Just a little more cautious here in the near term. We're seeing more volatility, and some of the parts of the markets are getting a little frothy here.
What would give us a reason for continuing to buy stocks right now, though, Denis?
So it's a lot of the same arguments we had in 2025. Mm-hmm. The CapEx spend environment, especially in the U.S., but globally, you're seeing a lot more CapEx, especially around that AI story. So that is we still think a fairly strong driver. We still think we'll see some benefits from deregulation in the North American market. We think we have better tax policy in the U.S. We're hoping to see some of that in Canada as well. So those are all kind of tailwinds that should help the overall markets. The valuations are a little stretched. We think interest rates might be a little more balanced here, maybe a little more risk to the upside, given the new Federal Reserve chairman announcement. Mm-hmm. Warsh has always been much more hawkish, so that could be a little bit of a headwind. So we think multiple expansion might be a little more challenged going into this year, mm-hmm. but we still see some fairly good tailwinds for growth in earnings, given the rest of the dynamics that are kind of fairly positive for the markets.
The big thing with war seems to be in part just reducing the enormous amounts of assets on the Fed balance sheet that were put there to stimulate the economy.
That has been his position. He was never really a big fan of the QE deployment, especially not QE2 and QE3. So if you were to follow through with that, obviously that would have an impact on your longer rates. Most likely, we'd probably see higher rates. And again, that would be somewhat of a headwind for multiple expansion, right? So we'll see how things play out. Still very early, but over the next few months, I think we'll get a better indication where he stands today. Mm-hmm. On the balance sheet, the Federal Reserve's balance sheet. And then I think from there, the market will start pricing in kind of what they expect to see on a go-forward basis.
You have a couple of stocks that you favor right now, CAE, and obviously with the world spending more on military aircraft, and they look likely to get more business for training simulators to train the pilots.
They do. On the defense side, you're seeing significant amounts of growth in that defense spending globally. And what we like about CAE is as you have different platforms that are kind of competing to win those contracts, CAE doesn't really, they're agnostic to the platform. So it doesn't really matter what types of planes that different countries will be deploying. They can train just about any platform there is. So we just like the fact that there's going to be an increased amount of spending globally, and CAE is very well positioned to basically win more of that share. We also like their defense business here, just that the last 7 or 8 years, it's been growing, but basically the profitability has been under pressure. But they're finally seem to be getting through that. We've seen that in the last few quarters. The margins have been improving. They're basically moving into a higher margin type backlog right now, and that should help sustain those better margins. So between the increase in demand, lots of money flowing on the demand side, and the improving margins, we really like the defense part of their business here.
You have another idea for us, Hammond Power Solutions. And we know the world is investing heavily in electrification, partly for these data centers.
That is the big driver, but there are other tailwinds as well that are very beneficial to the business. But the AI centers really is the dominant factor right now. So Hammond Power does one of the main products are these dry transformers. So as you have electricity kind of flowing through these high voltage lines, it needs to be essentially stepped down as you kind of connect into, whatever, an AI data center or hospital or manufacturing plant. And so there's significant demand there. So this is basically one of those picks and shovels type companies within this overall CapEx spend on these AI data centers. We think the transformer side of the business is one where there's a possible pinch point. So companies are fairly desperate to try and lock in that supply. And so that really gives the company very good pricing power. They've been impacted by some of the tariffs, some of the commodity prices increases, but they've had no problems pushing these costs through. And that's just because demand is so strong and there's a real strong requirement to kind of lock in the supply of these transformers. So we really like the way they're positioned here. They've increased their manufacturing capacity in Mexico. So over the next couple of years, as the revenues flow through this new capacity, we should see margins improve as well. And then we think they're in a cycle here where the next few years they'll have to keep investing in more capacity because the demand is that strong.
And then finally, Extendicare just closed a big home healthcare acquisition, and home healthcare a huge part of their business now.
It's becoming a bigger part of their business, and we really like that part of the business. It's a capital light type business, so we really like that. The funding behind home healthcare, you can see the government's really starting to apply more funding there. Ontario government increased their funding 2 years ago by $2 billion over 3 years. They did the same thing in 2025, except they increased it by another $1 billion for another 3 years. And one of the big reasons why they're pushing for that, there is a significant lack of supply when it comes to beds and home and long-term care facilities. Ontario alone is short about 48,000 beds today. They're going to need another 200,000 beds over the next few years. So this is kind of a relief valve, right? If you invest in home healthcare, it really helps it's a quicker dollar to have an impact. The cost of home healthcare is lower than a long-term care facility. So home healthcare will cost you about $100 to $200 a day, whereas a long-term care facility is $300. And as well, as you invest more in home health care, there's a lot of older people that are in hospitals right now just for kind of regular care for chronic type issues. As you give them that ability to be at home, to have that taken care of, you kind of relieve that pressure in the hospital. So it's a really good investment overall for the overall healthcare system. And Extendicare is kind of consolidating that market. So that was a very good acquisition. They've expanded their geographic market. And it's just a very good acquisition for them.
Denis, thank you very much indeed. Denis Taillefer of Caldwell Investment Management.